The big picture is things are largely unchanged on 3 months ago. We're still seeing price gains, although they've moderated. Turnover's lifted a little, and supply, both on market and physical supplies, rental vacancy rates, are still extremely tight. Sentiment-wise, consumer sentiment is still caught between this tension of very poor affordability, weighing on assessments of time to buy, but very positive price expectations. Net, it's improved a little bit, given a slightly less threatening labour market outlook and a slightly more promising interest rate outlook. But that's probably not a lot likely to shift the dial a lot on activity. Maybe we'll likely see prices a little firmer and turnover a little firmer for the rest of this year. Well, look, it gets a lot more interesting when we start to look further ahead to the medium term. Interest rates are starting to come up on the radar for rate cuts. We're not quite out of the woods yet on inflation. It's still quite high, and there may still be a rogue inflation number that gets the RBA to tighten again from here, and the RBA has been quite clear on trying to discourage markets from jumping the gun on the rate cycle. But we have passed the peak for inflation, and it's very likely that we've passed the peak for the interest rate tightening cycle. We think the RBA will start to ease rates by about September this year. And that sort of draws the question. So for housing markets, ordinarily rate cuts, and their whiff of a rate cut is enough to get markets picking up and a turn. But this time around, there's two ways this could go. We could see consumer sentiment generate another second leg to this cycle, particularly with prices. But that would nobble demand quite quickly. We're coming into this cycle with affordability very stretched to begin with, and even with some rate cuts, it's not going to improve dramatically. So that would tend to see a fairly short-lived recovery, prices and then turnover weakening. Alternatively, we could see a bounce in sentiment initially, but not much follow-through around prices. We may instead see owner-occupiers in particular seeing that their affordability situation is still not great. And that would tend to see sort of more muted price gains, but perhaps a firmer picture around turnover. And there's a big swing factor in all of this is going to be how investors react. The affordability problems really are around the owner-occupier space. And so if we go into this next easing cycle and we see a material pickup in investor activity, which is also not certain at all, that could be the thing that drives us one way or the other. We think on balance it's more likely to be a subdued response, and that price growth will be fairly muted compared to previous cycles. But that's where this cycle differs quite a lot with the previous ones we've seen.